Good morning. Today is Monday, December 5th. Thank you for joining us. I hope you had a great weekend. It was exciting weekend, a fun weekend, at least for me. Hope it was a great weekend for you too. So this week is going to be really fun here at Narwhal actually too, because we have a podcast that we're doing. We're recording tomorrow, another episode of Beyond the Portfolio. We're doing this with Barry Pensick, who was part of a very top secret operation in Vietnam. And it all kind of came out in the 90s in a CNN documentary in 1998 called Valley of Death. There was a big controversy with that. CNN had to ultimately retract the story. And I think it's just a fascinating tale. He just wrote the book on it. It was incredibly well researched and sourced. He's also written a book on investing for millennials. So we'll talk to him a little bit about that and just any career advice that he has. So we're going to be recording that tomorrow. Hopefully we'll get it out by the end of the week so you can listen to it on the weekend, but stay tuned for that. It's also Pearl Harbor Day on Wednesday and Tom's birthday. So looking forward to that also. Next week will be another exciting one. We're really trying to finish this year. And we have a Fed meeting and a CPI report next week. The CPI report comes out on Tuesday. The Fed meeting will be announced on Wednesday. That's when it'll conclude. And we're already starting to get some noise on this. And Tom, I'm curious to hear your thoughts on this, because we have our guy at the Wall Street Journal, Nick Timmerose, has another article out. He tends to do this about a week before the Fed meeting, and he comes in and basically tells you what the Fed is going to say. And he says that it looks like we're going to be raising by 50 basis points, which would be the highest level since December 2007, and that they will probably increase the terminal rate in their projections, but not by a whole lot. The question really then becomes is, how does Powell speak? Does he speak hawkishly or does he speak dovishly? And to what degree do they raise the terminal rate of rates?
I mean, the thing is, I was surprised by his tone last week. So I don't know how much he can really change his demeanor or tone or even the messaging so quickly without really causing the market to sell off or to at least react, I would say aggressively, one way or the other, up or down.
And you were surprised, for clarity, you're surprised that he was
so dovish,
yes.
Or at least that the reception was so dovish. Yep. I mean, we've seen the 10 years all the way back down. I mean, we had that jobs report at the end of last week, and we're already back down at a 350 on the 10 years. So that was basically a race in one afternoon. We saw it immediately spike. We thought, everything Powell said earlier in the week was being erased by this too aggressive jobs number. And then by the end of the day, it was nothing had happened really. And we're still kind of sitting at that level. If you look at futures, we're looking at definitely 2 rate hikes, if not the small possibility for a third on the 14th. I think that's kind of out the window at this point, but the futures are indicating about a 10% chance. In terms of the next one, we're looking at 1.55% or 1.55 hikes is the estimated number. So
it's a coin flip between 25 basis points and 50 basis points.
Functionally, you're just rolling forward that 10% chance and tacking it on top of a 1.5% chance. So I think that the terminal rate is somewhere around 6%. I think they've been behind the 8 ball. I think they continue to be. I think that if they do update the dot plot indicating a final terminal rate somewhere in the 525 to 550 range, I think that that's positive. I think that's more realistic, but I still think they're probably 2 rate hikes short. But by the time we would get to that point, somewhere in the middle of next year, there's quite a bit that could happen. I mean, you're looking at, another couple months between now and our next. So it's kind of a funny schedule because it's pretty lockstep. You go about every month, but right now we're looking at, the next hike is going to be on the 14th of December, and the next one won't be until February 1st. So there won't be anything in January. So we've got like an interesting little gap there. We've got Christmas, we've got the New Year, we've got a lot. And the first, I would say 45 days of any new market is always interesting. I mean, gold for whatever reason is always up like the first, hope springs eternal on the gold trade. And that causes people to think a certain way for the first 45 days of the new market. So there's just a lot. There's a lot that could happen, but my expectation is 2 rate hikes for the foreseeable future until we hit 6%. That's where I'm sitting.
And that would be certainly more hawkish than the market is right now, right? And where the Fed has guided to. So, for context, assuming we get 50 basis points on the 14th, which is pretty much baked in at this point, we're looking at a rate at that point at 4.25. And in September, when they came out with the projections, they thought that the peak of rates would be 4.5 to 5. It looks like that's now might get revised up to 4.75 to 5.25, which again, even then does not allow you much room for rate hikes in 2023. And Tom would say that he's a little bit more hawkish than the Federal Reserve is right now.
I mean, if you look exactly 1 year ago at futures, we were expecting that we would be getting our 3rd rate hike for the year 2022 on the 14th of December.
So we'd be at 1%.
We would be the estimated rate between 75 basis points and 1%. So I just, to say it's like I would say I'm behind by call it 75 basis points. They were off by 4.5%. In this first year. So I think it's interesting to think like expectations change very rapidly in this market. So it could break one way or the other, but my expectation is they're still going to be behind.
I think the biggest moving variable is going to be wages. Right now, there's another separate article in the Wall Street Journal saying that employers are trying to hold the line on wages, but with mixed success. We did see the jobs report on Friday that saw average hourly earnings accelerate from 4.9% to 5.1%. That 5.1% compares against an estimate that was just 4.6%. So Powell doesn't believe that there's a wage price spiral, but that's not really holding a ton of water anecdotally. Quit rates have declined a little bit, but we're still seeing wages increase rather significantly. So it'll be interesting to see what happens from that perspective. One positive I would note is that it does seem that China is moving a little bit away from these lockdowns, which should theoretically help supply chain. We did get a resolution to that railroad strike as well. But it looks like they continue to modify testing requirements in China, and those stocks are performing fairly well today. Tom, talk to us a little bit about OPEC. It seems like there was really no news to announce over the weekend. We'd been talking about this meeting for a while, and then Sunday came with just kind of a
Yeah, after all that, the first they're talking about cutting, then they're talking about increasing, and then there was just a ton of where is oil going. They ultimately came to the conclusion to not do anything, and so that sets us up for, I would say, a lot more uncertainty, particularly because the next meeting is not until February. So market forces theoretically are what's going to be driving the oil markets for the foreseeable future. The question is, what's that going to look like? Is demand going to surge with a potential reopening in China? There going to be more lockdowns. What's that path look like? It's exceptionally murky, and so I think that's even though it was a trade of 2022, it might be one that could either be a big boom or a big bust heading into 2023.
Oil's up a little bit this morning, but still kind of right around the lows of the last few months, around $81 a barrel. And we're seeing a little bit of a shift in the futures curve too. There's a little bit less surplus of oil here in the near term. And we do have oil inventories domestically that are going to be reported on Wednesday. So we're going to actually be keeping an eye on that. Now that comes out after our morning call, so we won't really be able to talk about that until Thursday. But that could be a little bit of a swing factor. Last week we had a big draw on oil inventories. Again, that's distinct from the Strategic Petroleum Reserve. And so I'm curious to see what happens with that. It seems like the refineries have turned around a little bit, which might help gas prices, but in doing so, they might tighten the squeeze on oil. So they might see refined products tread water or maybe even go down a little bit, but oil prices themselves actually increase. That remains to be seen. Last big story for today, and then we'll get to the calendar and the busy week ahead and give you a little bit of a preview of that. But Microsoft is willing to fight for the Activision deal, according to sources from Bloomberg. The FTC is wrapping up its investigation. We'll make a recommendation soon. The FTC, as we've talked about on this call, has discussed filing a lawsuit to block the $69 billion purchase of Activision by Microsoft. But for Microsoft, it does look like they're gearing up to fight this deal. I don't really know where to stand on this. I think that Microsoft may fight it. I think that if the FTC does file a lawsuit, it's kind of a fool's errand, but maybe Microsoft is just doing this and leaking this news to basically threaten the FTC. We're going to fight it. We're not just going to roll over. What are your thoughts, Tom?
Yeah, I think that ultimately it's going to end up costing the government a ton of money, win or lose. Though historically speaking, Microsoft, I think, is 0 for 1 on antitrust accusations against the federal government. And they took it to the nth degree the first time around with the, was it Internet Explorer or Net, whatever they call it at the time,
Netscape Navigator.
Netscape Navigator, installing it on every computer to basically create a monopoly around getting on the internet in the early days. So I don't know how this is going to go. I think it's a great deal for Microsoft if they can get it done. I think it's not a great deal if they're going to end up spending hundreds of millions of dollars on lawsuits to get it pushed through. I think it just ruins the value of the deal, and the time that gets dragged on and the pressure on the stock is not going to be great for anyone.
Yep. All right. Talk about the week ahead. We have a very busy week. Today, I think the biggest thing is the ISM services. We do have a couple companies reporting in conferences, so we could see some guidance updates on that. But the ISM services report is going to be the big one. We had a decent ISM manufacturing report last week in terms of slowing economic growth. And that's kind of what we want to see because the Federal Reserve is so keyed on that. But the ISM, Tom, talk to us a little bit about tomorrow. What are you looking for?
And I'd be interested to see what happens with NVIDIA. We sort of saw some positivity in the semi space over the last couple of weeks. It could be a major boom, major bust in the market when it's up, or the worst stock in the market when it's down. This year, we've sort of been more the latter. ISM services, services have definitely been the part that's been growing of the economy versus manufacturing. When we get these numbers, usually there's a massive dichotomy there. If that continues to look very, very strong, I think we may see a little bit of a faltering in the market, probably a little bit of a sell-off in bonds, just in anticipation of the Fed not being happy with those numbers. And then for the rest of the week, there's just so much data coming out. I'm interested to see, stuff like Lululemon on Thursday. Costco obviously is going to be huge for us. We have a lot of exposure to Costco. There's just so many different moving parts. It feels like for some reason, this is the first year where there's just a ton of news coming out between the second week of December and the end of the year. Usually it's almost like a dead period. There's not a lot going on, a lot of Christmas parties and meeting with clients and kind of getting set up for the new year. But this year it's just nonstop action. It feels like.
Yeah, it's full throttle. And I think that's it's kind of exciting, but it's also kind of the same thing that we've had for the last few years. I feel like we've been full throttle, full on the gas for quite some time. I think the Georgia runoff election tomorrow is going to be incredibly a lot of people are going to be focused on it. I don't know how consequential it'll be in terms of what happens over the next couple of years, but that will be something that's definitely watched. And full disclosure, I have not checked the polls on that. My guess is that it's pretty much a toss-up, which essentially means I really don't have any good degree of forecasting on that. I would say it seems like people, just anecdotally speaking, I think people have kind of burned out, and I wouldn't be surprised if that takes a little bit away from Warnock versus Walker at the margin. So maybe the Democrats lose a little bit there. But having said that, again, anecdotally, I've heard stories of very long lines for early voting. And so maybe that's going to hold up. And typically that tends to break for the Democrat candidate. So I really don't have any good clue on the Georgia runoff election. I wouldn't make investment decisions based on that. All right. With that, we'll close it there. We do have some mortgage data coming out on Wednesday that I'm going to be watching, and PPI, producer price inflation, on Friday. So the market will be keyed into that as a signal for CPI the following week. But we're going to leave it there. Stay tuned for the rest of the week. A lot coming out, and we do have that Beyond the Portfolio podcast that'll hopefully be out by the end of the week. With that, have a great day. Stay dry